So
I used to be a nurse. Where do you normally go, like to Wellstar or anything? When I left nursing in June. You were there at Wellstar. Okay. We're talking about North Fulton Hospital.
Are we on?
Were you at North Fulton Hospital?
Yeah, I just need to get my PowerPoint up.
Oh, okay. My mother actually died at North Fulton Hospital in April, so I was thinking maybe
Okay.
that's.
Never been to Kennestone?
No. I mean, we had our whole family there, just, and you would have remembered, because we just trooped in, we had 5 children in my family, and they let us all in there,
Yes.
even though they weren't supposed to, but we were all there. So I knew you would have noticed. I'd have been there.
And sometimes, yes, I know, let me turn this off so you can see. It works better when you just put it on here. That thing is driving.
I'm trying to find it.
Yeah, it's driving me to drinking. Let's see if we can find it now.
I seriously can't see it. There we go. There we go. Yeah, I think the mouse sensitivity set real high too.
Can we do this, Jill?
Yeah, go ahead. Is that better? This one? That's hard to even see. How's the different areas?
oh, let's see, a lot of calls, but I only got 3 connections, 0 appointments.
The rest of the day,
Yeah.
this is gonna be a great time.
Monday's been a difficult time to connect with people. They're a week.
Do it again later on.
Yeah, in the morning.
I seem I get people in the evening.
Right, yeah, because they respond in the afternoon.
Yeah,
You just send out all the texts in the morning, leave all the messages, and then you can respond.
Yeah.
Yeah.
So,
Hey guys, we're setting up. We'll be on shortly. Can you hear us, Yvette?
Yes, ma'am. Good morning.
Good morning, thank you for responding.
Yes, ma'am. Have a great day.
Now, let's see how it works with.
So now
Go
you
back
just
to
click over
here.
here and then share screen. It's right
Should be
there.
that one.
All right, can you guys see that? Yvette? Yeah?
Yeah. Yes, I
Well,
can see.
Good job. Your eyes on the roll, Yvette.
Wow. Well, GAR has created a rule that we are not allowed to attend any GAR meetings. So every once in a while, when I do a forms committee meeting and I have to drive, like I just turn off my camera. So at least for those, I'm not trying to write anything down, and sometimes I'm just like listening. I'll try and like not speak to it. So, but we'll go ahead and get started. This is I'll probably like flash through some of these slides because this is a 3-hour CE class. So obviously we're not here for 3 hours. So we're really just gonna hit the high points of this for the next hour. But honestly, like I struggle to teach this as a 3-hour CE class anyway, because I don't think it takes 3 hours to understand what a real estate agent needs to know about 1031 exchanges, because there are lots of big parts of them where you shouldn't be giving advice anyway.
Yes.
Just pushing people in the right direction, like bringing up the possible topic, but not necessarily giving them like the minutia of their tax qualifications and what their tax, results are going to be from any of this. So, make sure it keeps going. Okay. So obviously we're looking at these 1031s when we've got property that's being sold, it's going to be sold as for a profit. And that is almost all of our sellers these days. We are dealing with this with IRS taxes. We're also dealing with this with sellers who are no longer located in Georgia and have state taxes, because they're making 6 figures worth of profit on these properties these days, because they've held them a while and because honestly, it's just a crazy market. So the profit that they've got is what we call the capital gain. If they've held it for more than a year, it would be ordinary gain if it were held for less than a year. We have a few of those too. The IRS code sets out what we can do to try and prevent those taxes from actually hitting us. So where we get the term 1031 exchange is because it is section 1031 of the IRS code. So that's why we call it, it's nothing special. It just happens to be the code number where the original law was written. So when we are dealing with the sale of someone's primary residence, there may be cases where they would want to do a 1031. What I see happening most often is agents are giving tax advice at closing and not good tax advice, which is even worse than just giving, regular tax advice. So when I sell my primary residence, I'm not going to have to pay taxes on it if it meets certain criteria. And let me see if I can get to it. I think it may be up at the top. Okay, so if I used it as my primary residence for 2 of the last 5 years, that's usually the part that real estate agents know, and then they don't know there's anything else after it. If you lived in it for 2 years, you don't pay taxes on it. That's way too simple, and you're missing the other 5 parts of the test. The other is that they haven't sold another primary residence in the last 2 years. That can happen because the first part of the test is 2 of the last 5. So I could have owned a property for 5 years. I lived in it the first 2 years. I haven't lived in it in the last 3 years, but I may still be able to avoid gain. It really just depends on what I did with it during those 3 years that I wasn't in it. So if I used it as my primary residence and then maybe I let my child live in it for 3 years and didn't charge my child any rent, then that would be a property that would still be considered my primary residence, even though I haven't lived in there for 3 years. The seller hasn't used it for business or rental purposes. So again, that's why I gave the example of let my daughter live in it, because if I rented it out for 3 years, then again, that's going to be something. And usually when I ask people at closing, and when we go through these documents at closing, I ask them the questions and then I fill out the form for them. And one of the reasons for that is that the form has 2 double negatives in it because it's the IRS language. So it's extremely confusing. So I have not used it. No, I haven't used it. Then the answer is yes, because yes, I have not. But haven't used it for business or rental purposes. Obviously, the rental is fairly easy. We know if we're renting out the properties. I sometimes have to give people a little bit more information when we say, did you use it for business purposes? Because we all work out of our homes these days. The test is, did you claim a portion of your property as a business? So let's say you took your home office and you carved that piece out. It doesn't mean that you're going to pay a lot of taxes on everything. It just means that I have to report this sale to the IRS because a portion of that house was not your primary residence. You were using it for business. And, most people that are just working at home aren't doing that. It could be that we have a lot more of that as we have people regularly working full-time from home post-pandemic. And it depends upon whether they decided to make the decision of carving out a piece of their property and considering it a business expense. And there's business advantages to doing that while you're in the property, because you can claim a portion of your house, so a portion of your mortgage, as a business deduction. But then when you go to sell the property, we're going to have to report the sale to the IRS, and it's going to get a little bit more complicated. So hopefully they're having a discussion with the CPA before they're doing it. And then obviously when they file taxes that year afterward. There are a lot of times when you could do your own taxes with TurboTax. That might not be a case where you necessarily want to, may want to actually pull in a CPA. The sales price is below $250,000 for an individual or $500,000 for a married couple. So when I am going through a closing, if I've got a $750,000 property, I don't even ask them the other questions. It doesn't matter, because once the sales price is above $500,000, I'm reporting this sale to the IRS. It does not mean that they have tax consequences from the sale. It just means they have to justify it when they file their taxes. Because I could sell a property for $750,000 that I bought for $800,000. Well, I'm not going to pay any gain on that. I lost money on that. Or I could be selling a $750,000 property that I paid $250 for. Well, I'm probably gonna have some gain on that one. So that is, whether we report it is really just based upon the sales price. Doesn't take into account what they paid for it or what they may have put into the property as capital improvements. As someone who's dropping a whole chunk of money on my property right now to completely rebuild my backyard, when we go to file our taxes, I mean, the one thing is my husband, I'm making him manage this project with all the vendors and all the supplies we can't get in these days. But one of the things that I'm making sure that we do is document all the way through, because we're writing $30,000 and $40,000 checks at a chunk to do pieces of this. So that's going to be stuff that we're going to want to have receipts for later on when we go to sell the property.
So does all these bullet points need to be checked, or it's just saying?
Once
this
you
one
fail
failed?
one piece of this test, I report the sale to the IRS.
Okay.
And again, that first one is usually the only one that anyone asks about without looking at the other ones.
I have
And
a question.
yes,
So if it has to satisfy all of these in order not to pay capital gains on it, or does, so I just wanted a clarification, like if you have a property whose sales price is $250, but does that mean you don't pay capital gains tax on it, period, because of the price? Or it also has to satisfy the 2 years principal residence and everything else as well?
if it has to satisfy all of these for us to consider this a non-taxable event. If you
Okay.
pass every part of this test, we mark you exempt in our computer. We don't even report you to the IRS at the end of the year when we are filing all of our 1099s. But if
Okay.
you fail any part of this, and the last one, let's see if it, go back, if it's on there, no. The last one that we added in the last few years is 2 more questions. It is, have you done a 1031 exchange in the last 5 years? And most people, when I ask the question, I say, and if you've never heard of it, you've never done it. Because most people have not even heard of a 1031 tax exchange. If they answer yes, they did a 1031, then the question is, did you use the 1031 money to buy this property? Because if you use 1031 money, then there is the possibility that you will have gain from that. What you can do, and there are parts of it later on in here, you can take investment property along the way and eventually escape all taxes. What I could do would be to sell an investment property that I have. I could buy another investment property down in Florida. I could 1031 that money so I don't pay any gain on it. And then I could move down to Florida for my retirement. And if I either die in it, or if I live in it for 5 years, then I can sell that property and I will never have to have ever paid gain on it, even though the money that I used to buy it was investment money. So that's why we have to ask the question, have you done a 1031 in the last 5 years? I haven't had one person yet in the 10 years we've been asking that question that actually used 1031 money to sell what is now a primary residence. It's one of those things where you probably do it toward the end of your life. It probably is a beach property somewhere or a mountain property somewhere, and it's not something that we're seeing a lot. But these are the questions that we ask as to whether or not we report. Most of the 1031s that we are seeing aren't people trying to sell their primary residence. It's people trying to sell one investment property and buy another investment property. And that is really what the 1031 program is there for. It is, the reason that it was created is I don't want to be stuck in an investment because I can't afford to pay the taxes when I sell it. The reason that it is there is maybe I want to flip from one property to another property and I want to defer my tax gains till the end. Because if I lose money to taxes every time I sell an investment property, then as I go down the road of changing out my investment properties, they get smaller and smaller and smaller because I'm eating up money paying taxes all along the way. Where with 1031s, I've got all of the money that I make on it, I can use it to buy another property and just defer the taxes as we go. The IRS doesn't recognize gain if we answer all of those questions, but really what we're talking about here is the exchange of property. So it's usually something that we've used for a trade or a business held for investment purposes, and we exchange it for another, what we call like kind property. So it's usually something that is agricultural. We're buying another agricultural property. There are certain qualifications that we normally see for investment property. So it's the businesses, it can be rentals, it can be agricultural lands. That's typically what we're seeing. So with the tax-free or tax-deferred program, tax-deferred is probably the more accurate way to describe it. The goal of this, although you can use it to completely eliminate your tax consequences, really the purpose of this is just to kick the can down the road as to when we pay Uncle Sam. And that would be if I decided to sell that last investment property at the very end and fund my nest egg that I'm going to survive on forever, then I would pay taxes on that point, realize my gain, and go on. So again, this course isn't, and it's a 3-hour course, so we'll fly through parts of it, but this is not intended to be tax or legal advice. And you should not be giving tax or legal advice. There's one thing that you should know going through this is that you need to understand the program so that you can ask basic questions, but it is not a sign of either ignorance or stupidity for us to say that's not our wheelhouse. I get tax questions all the time at closing. I know enough about tax to be dangerous, right? So, but it is no slight to me if I say, that is a great question that really needs to be discussed with a CPA. So that would, I would recommend if you don't normally use someone, if you have these sorts of questions, that you may want to use a CPA this year. I will also tell you, just because I was personally involved in a transaction, can you close that? Yeah, is that even some of the more discount tax brokerages like H&R Block, I dealt with a seller who we were working out Georgia issues, but he used H&R Block. He did have one human being who would answer questions and help him complete the stuff. So I was actually fairly impressed because I figured those were just pencil pushers that wouldn't actually give advice. But I was actually impressed with the information that he got and the assistance that he got using a discount brokerage. So we want to give you as much information and avoid some of the pitfalls as we've got. The taxpayers have been taxed on their gain because, obviously this is a property that they're selling. If you don't do a 1031 correctly, if you don't meet very bright line deadlines and details, this becomes a taxable event. There is no wiggle room with the IRS, as anyone who's ever dealt with them directly probably knows. So they need to make sure that they're abiding by timelines and the formalities of what we need to do. There should be a stipulation in your contract if you're doing a 1031 exchange, whether you are doing the sale of a 1031 property or this is the acquisition side, so they already sold a property with a 1031 and now they're buying the replacement. In either case, you have to put a stipulation in your contract. And the reason for that is that when we do a 1031, there is technically an assignment of the contract. Because that qualified intermediary, the person who takes the money when it's sold so that the seller never touches their money, that person is listed as the seller on the settlement statement with the human being. Let's say I'm the human being who's 1031ing the property. My 1031 company is going to sign as seller, and then I'm going to sign below it on the settlement statement acknowledging the terms, because I'm really the one reviewing the money, right? I'm really the one making sure my payoff looks correct and the commissions are correct, but I'm not listed. I'm listed as the seller on the deed. I'm listed as the seller on all of the tax forms, but on that settlement statement, that qualified intermediary, that 1031 exchange company is the one who's listed. So that's an assignment of the contract. And the same thing when I go to purchase my property, I'll acknowledge the numbers. I'm the one who chooses the sales price. I'm the one who negotiates. I'm the one who's going to sign the purchase contract as the buyer. But as part of those 1031 documents, there is going to be an assignment so that the 1031 company is listed as the buyer on the settlement statement, with me only acknowledging below that. And what our contract says with regard to assignments is that they are not allowed unless the other side approves, and the other side does not have to approve. And we really only talk about here what happens if the buyer requests an assignment. And we have said here that the seller can refuse to allow an assignment for any reason or no reason whatsoever. We don't usually, the contract doesn't anticipate as much a seller assignment because the owner of the property should be the seller, right? There shouldn't be a reason that we're necessarily assigning it on the seller side. But we have said that the seller does not have to agree to that, which means that we have to have a stipulation in our contracts that allow for this 1031. And I have seen what happens when agents try and just write a quick stip, and they're usually not, it just says buyer and seller agree, seller's gonna do a 1031 tax exchange, but it doesn't approach what we need with regard to an assignment and documents that the buyer's gonna have to sign for the 1031 company. If you don't put a stipulation in your contract, you can't make the other side sign a bunch of documents. I mean, they can refuse because they don't understand it. They can refuse because they don't like you. They can refuse because they don't have to and they don't want to sign one more thing than they have to. It doesn't matter. They can absolutely refuse. So what we have here are two GAR stipulations. They are in our list of special steps. They are 506 and 508. They are clearly labeled as a buyer doing a 1031 or a seller doing a 1031. So if you have a 1031 exchange, just take this language and pop it into your contract.
Yeah.
The other side should not be concerned about this. This is all very much just a technical assignment of the contract. And we have said in here, the very last sentence, moreover, the seller or the buyer shall remain fully obligated to perform all obligations of that person under the agreement, even after it's been assigned to a qualified intermediary. So we have made sure that we are not damaging the other side, but we're making sure that the other side will cooperate and sign the 1031 documents. Sometimes the qualified intermediary, the 1031 company, will send those out during the contract time. Sometimes they're just stuff we sign at the closing table. And truly, if we're signing it at the closing table, usually there's not too much of an issue. But we do need to make sure that those things get done and that the other side has to do it. So some of the quick definitions, the basis is the starting point. So my tax basis is going to be what I bought the property for and the plus the capital improvements I made to the property. So with regard to the house that we have right now, my purchase price was $1,060,000. The amount we're putting into the backyard is sadly about $220,000. So you add those two together and those are going to form what my basis is. The adjusted basis would be, and actually the true basis is the purchase price. The adjusted basis is after I add my capital improvements, and then also I may have some depreciation. With regard to depreciation and some of those more complicated things, again, the CPA should be giving those numbers. That really should not be something that we're all trying to figure out. Transactions that involve exchanges, gifts, probates, and trust distributions may impact the property's adjusted basis. We also may have times where we have more than one owner of the property. So we did a 1031 last month where you had two sellers and only one of them was doing a 1031 exchange. The other one was realizing their gain. So it is possible to split that. They were both 50% owners. So the purchase price gets split in half, the sales price gets split in half. They shared everything 50-50. And so that's what the one side wanted to do a 1031 for their part of it.
So I'm a little bit confused. So if someone is reaching out to a realtor wanting to sell their home, are we supposed to be asking them how long they've been there? Like, I'm confused.
I would not, quite frankly, I don't think that that's a can of worms that you need to open. If they start to ask you questions, you need to point them in the right direction, but you're not here to be their tax advisor.
No.
You're not here to raise tax questions. Now, if you're dealing with an investor who you know is selling one piece of property and turning around and planning to immediately buy another, then that may be a time where you have a conversation of, is there, have you thought about doing a 1031 exchange for your sale?
But if they lived in their house for a year,
I would,
don't.
no, do not raise, they're big boys and girls. Don't raise a whole bunch of questions that are gonna be so complicated that you can't answer anyway, right?
Okay, they should already know about it.
And I'm not saying that they do, because they come to closing and I ask them those 5 tax questions. And they go, oh, wait, well, I don't want it reported to the IRS. Well, I'm sorry, you're selling an $800,000 property. Uncle Sam makes the rules and Cheryl King just follows them. There's, and I'm not saying that you, and I tell them, I'm not saying that you're gonna pay taxes. All I'm telling you is I have to report the sale to the IRS. And whatever you do or do not owe in taxes, that would be the thing that you work out with your CPA when you're filing your tax return for this year. And that satisfies, 9/10 of the people that are out there. The other 10% weren't going to be happy with anything that I said. They probably were upset about something else when they came in, and now that's just going to be the thing that they latch on to during the process. So this is some examples of the purchase price and the adjusted basis. The boot is anything that they end up having to, so they may have a circumstance where they are able to avoid some of the gain, but not all of the gain. And the gain they do realize is what we call the boot. It's the little something extra in there, but that's something that's getting worked out with the 1031 company. It could be that they were paying off a mortgage, so they can't use some of that money to buy the new property because it's going toward the mortgage payoff. Or it could be that they've got $250,000 in gain that they are doing a 1031 for, but they can only find another property where they end up spending $225,000. So they have $25,000 in gain, but that's still better than $250,000 in gain. We're not saying that it's a bad thing. It's just something that exists. It's not that you have to use all of it or you pay taxes on all of it. It could be a situation where you're using some of it and you pay taxes on some of it. So the capital gain is the amount that we're paying taxes on. Deferral is obviously what we're trying to do with the 1031s in pushing the tax consequences down the road. You have these days direct deeding. As I said, it used to be that the 1031 company would just come in and sign everything. The only thing that the 1031 companies are signing these days are just the settlement statement. We're not transferring the title from the seller to the 1031 company and then the 1031 company to the eventual buyer. We used to do that with 1031s. We used to do it with relos too. Relocation properties used to be handled the same way. The EAT, the exchange accommodation title holder, that is that qualified intermediary. That is that 1031 company. What happens, and the reason that a seller doesn't have to pay taxes on the money is because they're never touching the money. So the money goes to the 1031 company. The 1031 company holds that money. The 1031 company sends that money to the purchase transaction. So the seller never touches those funds.
Just out of curiosity, how much does it usually cost to use this exchange accommodations title holder, the company itself? How much do they charge? Do they charge a percentage?
No, I have not seen that most of them charge a percentage because this is a very pro forma service, right? So, it may be, $750 on one side, $150 to $250 on the other side. I mean, I would say probably, somewhere between the total of like $800 and $1,500 would be the total of the charges that you would pay for it. And they get charged on the settlement statement. So they're considered a cost of the purchase. The exchange period, that is the time after someone has sold the property and before they have bought their new property yet. they have a certain period of time to identify the property, and then the amount of time that they need, obviously, to actually make the transfer. So they really have to have identified in 45 days, and they have to complete the sale within 180 days. If they do that purchase on day 181, then they are going to pay taxes on that money. It is a very bright line deadline. The exchanger, that's the person who's selling and buying the property. So that's the person who's trying to defer their gain. Fair market value is what the property is worth. Usually when you're doing third-party purchases and third-party sales, fair market value is also going to be what your sales price is. If you, there would be a possibility that you'd have to use some other number if you were selling to a family member doing something that wasn't actually a third-party sale. So again, that identification period is 45 days. So once I sell the property, I have a month and a half to identify all of the properties that I may want to buy. I can pick a lot of properties, and I should pick as many as I might possibly want to buy. So because let's say one falls through, then I've got options for another property that I can purchase. You can't do things like just identify every property in Cobb County or get all creative with it like that. You do have to actually identify specific properties for those. But there is a certain, and you have to be able to buy a certain percentage of them. So you can't just blast out like a list of every property that's on the market. But they should choose more than one just in case something falls through. So like kind property, again, it's not necessarily that it's similar in use, but it's intended for a similar nature. So either to run my business, run my trade, or as an investment property. So it can be raw land, it can be rentals, it can be farms, office and commercial property, motels and hotels, golf courses, some recreational properties, multifamily rentals, retail and industrial, leasehold interests of 30 years or more. We don't see a lot of things with ground leases, but I have a friend whose family owned land under the Marriott in New Orleans. And when Katrina happened and the hotel went down, they exercised like an option to purchase because Marriott didn't actually own that land. They had a 99-year ground lease for that property. Once you get past 30 years, it's the presumption that it's very close to ownership, and we can actually do sales that involve ground leases like that. So it has to be in the US. So there are foreign properties that can be exchanged, but I don't think we should get all that complicated. I think we should stick within the US. Investment properties can be exchanged for personal residences. And then the qualified intermediary accommodation or the qualified exchange accommodation agreement, that is the agreement that the person who is doing a 1031 signs with the person who's going to be holding the funds. These qualified intermediary 1031 companies tend to be people that are either tax related, like CPA companies may have divisions that do these 1031s. Also, our title companies do these 1031s and act as qualified intermediaries as well. So because it is something that is related to real estate, and it's very perfunctory in the way that it happens. The one thing that I will say, if you are an agent in here, is that in one of these transactions is that you make sure your client is the one who chooses who the 1031 company is. Please do not choose their vendor for this. There were two transactions. One was another law firm, and they actually got sued. They recommended a 1031 company, and that 1031 company stole funds. So that was liability for the law firm. I had a transaction where we were doing the acquisition of the property, the replacement property, and what happened was their qualified exchange accommodation agreement allowed that 1031 company to invest the money while they held it.
Oh.
And the agreement said as long as we do a safe investment, we're not responsible if the money is lost. And what the qualified intermediary invested the money in was a municipal bond. So it was a government bond, which you would typically think was very, very safe. The bond failed. So the money was gone.
Oh my God.
And my purchaser had no right of action against anyone for that. I mean, you can try. I don't know that you would be
Is
successful.
that in the fine print, so to speak, that they're
Well-
allowed to, or they're allowed to do that?
I don't know how many of the qualified intermediary, but I will say I have never forgotten
Oh
that
my
experience,
God,
right?
I know.
I have never recommended
That's
a
crazy.
1031
No,
company.
you choose your own.
You
You
choose,
choose your own.
you ask your CPA
Yeah.
who a good person is
God.
to use. And the only thing that I can tell you is that the agreement that you have with them for what they can do with your money while they're holding it, you need to make sure that you understand
Oh, no.
what they can and cannot do with your money, because they've got it and you don't.
Right.
So that would be my
Scary.
suggestion. Oh, yeah.
God.
I mean, and again, and I think at that point, what happens is he has to pay taxes on it because he didn't use it within 180 days, but he can also claim a loss because like the money was lost in an investment. But that didn't help him because he couldn't buy the new property either. It just wiped out his tax consequences, but that's my guess as not a CPA as to what happened with it. The qualified intermediary is the actual, you know, when I say person, it's really the entity, but that's who is holding it.
Mhm.
So we typically just call them 1031 companies, but their actual term is qualified intermediary, accommodator, facilitator. All of those are words that we can use. There is no requirement under the 1031 code as to who can be the qualified intermediary. So I could, in theory, ask my sister to be my qualified intermediary. And as long as she abides by all of the rules and I abide by all of the rules, IRS cannot complain. I would not do that, even though my sister actually is a CPA. Like that just feels wrong and like a bad idea. But I could, or you know, I could use someone else, a family friend who isn't a CPA at all. But there are, and we talked about what the fees are. The fees are relatively nominal, and you really do want to use some company that does this for a living.
Oh, yeah.
And this is all, you know, this is all that that division of that company does at the end of the day. So the realized gain refers to the gain that is taxed in a successful exchange. The gain is only realized and it's not taxed. And then the recognized gain is the gain that is subject to tax. The gain is not only realized, but it's recognized by the IRS. So I realize it when I sell my property, but it's only recognized if I get it and I have to pay taxes on it. Related party, obviously members of family or common corporation. So I can't actually use my sister as my qualified intermediary. I could use a random family friend who doesn't know anything. The relinquished property is the property that we're selling, and the replacement property is the property that we're buying. So, and then the sale of property is just obviously when property is sold for cash rather than exchanged for like-kind property. There is a delayed exchange. This is named for a particular court case. So, you know, it's not that the courts have sanctioned some of these little bit more sophisticated exchanges, but they are also not going to say that it wasn't necessarily allowed. Our goal, honestly, is just to review the basics of 1031s. Anything that they're going to do, like a reverse exchange, you can do your purchase before you do your sale. And there may be a good reason to do that these days because let's face it, selling property is a little bit easier than buying property is right now. But you have to fund it and then you have to replace that money through the qualified intermediary. Those are all really conversations that I think the 1031 company needs to be having with our clients. I don't think we should be proposing creative solutions for their tax consequences. But that reverse is allowed. Simultaneous is what we see sometimes where they're just happening at the same time. So if you already know what property you want to purchase and you want to go ahead and put a contract on that, we can at that point do the sale and do a back-to-back closing, quite frankly. And as long as they never really touched it, it's going to depend on the 1031 company as to whether or not I actually have to quickly like wire that money out and have it come back in the space of an hour, or they sign something that says that, they are approving that I transfer the money from one transaction to another. But in those cases, obviously, if they've already been able to find their replacement property, we're not worrying about our deadlines because we're not getting anywhere near 45 days or 180 days because we're already under contract, as long as obviously the sale closes too. So, and we hope that when we do back-to-backs that both sides have been actually closed.
Right.
It's when it's back to back to back to back to back, and the first one falls apart.
Oh my
that we-
gosh. House of cards.
Exactly, definitely a domino at that point. So there are some court cases about these 1031s, because whenever there's been a very technical violation of it, then obviously it's going to be something that gets litigated. So, these things are honestly very straightforward. Some of the pitfalls that we have is that the taxpayer can't have any constructive or actual receipt of the funds, so they can't touch it in any way. And sometimes that also means, I'm moving that so I can actually see my slides. That also means like how we handle the earnest money on the purchase side of it. Like we may have to do some things in order to get around that. And we will have times on the purchase side of the transaction where we refund the buyer their earnest money at the closing so that all of the 1031 funds are used for the transaction, because that money that was the earnest money wasn't 1031 money, right? It was actually just money out of their checking account. But any of us who do these, the 1031 company, obviously it's their job to go through the settlement statements. They review the settlement statements and have us make any adjustments that we need. And we as attorneys, there are a lot of us that are used to doing 1031s. I've done a ton of them. The most commonly utilized tax planning strategy available for investors. So this is really the thing that people know about the most in terms of something that they could do to try and limit their taxation when they're trying to sell and purchase property. Again, the delay is 180 days. And of course, now this is going to move to the other side.
Because that's the way it rolls.
Exactly. So step one is the sale of the relinquished property. So before closing, the taxpayer hires a QI, a qualified intermediary, that's a 1031 company. The qualified intermediary, the attorney or CPA prepares that exchange agreement. They send over documents that are the assignment of the contract, and then they send us closing instructions. They send us the exact signature line of how the settlement statement should read. They send, it also has whatever they're charging in fees for this transaction. It sends timelines for, we need to get a settlement statement 24 hours prior to closing, whatever those little things are. It's usually only a page or two of instructions to us as to the basic things that we need to do. And then for the sale, the instructions may call for a direct deeding, and it really usually does these days, with then the proceeds going to the qualified intermediary so the taxpayer doesn't touch it. And access to the funds is limited for the remainder of the exchange period. The IRS code provides strict rules relating to how the funds get released to a taxpayer, even if the taxpayer decides not to go forward with the 1031. But again, these are conversations that the QI, that the 1031 company should be having with them. For step two, they're going to find their new properties. So within 45 calendar days of the moment that the other closes, the identification is proper only if the property is designated as replacement property in a written agreement that is signed by the taxpayer. So that will be something that the taxpayer needs to be giving to the qualified intermediary, and hopefully the QI is asking for those things. A good one hopefully would be reminding them of their deadline. So on day 35, 10 days from now, I need But it does need to be signed, which means it cannot just be an email with a list of properties unless you sign the body of your email with your electronic pen. A written document must be in hand, delivered, mailed, or otherwise sent to the seller of the replacement property and any other parties involved other than the qualified intermediary. So this means we have to have a sales contract. Okay. The identification rules, there's the 3 property rule. You can identify 3 properties regardless of what their fair market value is. So everyone is allowed to pick 3 properties and probably should pick 3 properties as their
That was gonna
purchase.
be my question, because you said, you know, you can go ahead and identify more than one
More
property.
than one, but you,
So up to
exactly.
3. Okay,
Up to 3 no matter what.
Yeah.
The other is the 200% rule. So they can pick as many properties as they want, as long as the money that they have to use, they could purchase at least, you know, it doesn't exceed 200% of what they have. So if I got $250,000 in gain, so that's the money that the QI company has that I'm going to be using for replacement properties, then that means I could go out there and find 10 $50,000 properties, because the total of that is $500,000, and that's 200%
Okay,
of what I have.
all right.
So I can take a big bucket of money and buy a bunch of small properties. And if I were looking to go buy a bunch of $50,000 properties, then maybe I do want to identify a whole bunch of them,
Right.
so that I have more options on it. The last rule is the 95% rule. So as many properties as possible as I want to, without regardless of fair market value, provided that 95% of the value, provided 95% of the value of the identified properties are acquired. So I have to pay 95% of, I have to buy 95% of what I choose.
Okay.
Okay. So you have to kind of run the numbers at that point. It's enough for you to be aware of. You don't have to commit these rules to memory, but it just gives you a general idea. If you have someone who was selling, you know, they sold a property in another state, they have $250,000 sitting there. They contact you because they need to find some replacement properties. You at least know that there are limits and guidelines for how many properties that they can identify in that first 45 days. And they should be confirming all of this with the person who is the qualified intermediary to make sure that they're making good identifications. When they purchase the replacement property, again, they have to do it within 180 days. Bright line. If it gets, I mean, this is one of those cases where we also have to remember that when they're buying property, the seller might have an 8-day unilateral right to extend. We need to make sure that this closing is happening inside of the 180 days, to the point that a 1-day delay isn't going to create gain for my $250,000.
Right.
You don't want to be running this to the
the
very,
line.
no, please don't run this to the line.
Yeah.
I'll stay up with you till 11:59 to try and get it closed. But let's not do that,
Yeah.
if at all possible. So, and the only other thing is it may be adjusted if the taxpayer has a filing date. So typically that's going to be April 15th. So if it runs into the filing date, April 15th is also your deadline. So this may not be something that you want to do on March 15th, where you don't have quite as much time, unless of course the taxpayer can also file for an extension on their taxes and bounce that date out a little bit.
Yeah.
So you obviously have the most time if you're doing it on April 16th.
Yeah.
So the replacement property has to be one of the identified properties or all of the identified properties. The taxpayer assigns the contract again to the QI, who's going to sign the settlement statement. The QI will either purchase the property with the exchange proceeds or cause the transfer of the property to the taxpayer in a direct deed. And what we're going to see is the direct deeding. So they will send me another set of instructions that says I'm authorized to deed the property directly to the taxpayer, and these are going to be the fees that I charge. And we need your wiring instructions so that we can send you the purchase proceeds that we're using. And they can have additional money, obviously, that they're putting down on it at that point too. But the goal is to at least use up all of the money that we have sitting there as gain. So the timeline is 0 is the day we close on the sale, 45 to ID, and 180 to close. The reverse is when we literally do this in the reverse. So they do their purchase of it first. It still has to be completed within 180 days. It's just that then the sale has to be completed within 180 days. So the replacement property is purchased by the 1031 company and held until the sale closes. And then when the sale closes, then the proceeds go to the 1031 company, and the 1031 company is going to deed the property to the taxpayer. The taxpayer would pick out the property, the taxpayer would negotiate the purchase of it, but the qualified intermediary would have to do it, have to make the purchase. The fees for this are going to be higher because the QI is also front money for these things. So this would be a little bit more of an expense for some very understandable reasons. Again, that's what we call a parking relationship when it's held with the 1031 company during that period of time. So I'll go through the rest of those, get to the end in our last 10 minutes. This talks about using it for some improvements on the property. So it may be this gets a little bit more complicated too. There may be some times where it can be the acquisition plus some build out cost, but that's also going to be something that they need to discuss with a 1031 company. But it is at least there. If they're selling a fully functional working farm, but they're buying raw land where they're going to build a farm, then there would be the possibility that they could do something. Not talk about related parties. We won't talk about the personal property either. Personal property happens a lot with things that have farm equipment and other things that are sitting on it. So some of those things, I mean, you know, we're not talking about a dresser drawer. We're talking about a $250,000 tractor. So those things can be extremely expensive. We already talked about what 1031 refers to. It refers to the code. Why we use a qualified intermediary. That's a safe harbor for the money. We're not touching it. Therefore, we don't have to pay the taxes on it. So a safe harbor is just anything where we've carved out a special exception. That is a term under the law for anything that we're allowed to do in a situation where we aren't typically allowed to do something. It's what we call a safe harbor. Why is a tax deferred exchange a popular financing tool? If done correctly, investors can defer taxes due until much later on. It also enables them to have access to all of their equity instead of having to set some of their equity aside to pay taxes when they are doing the sale. It allows them to exchange one investment property for another and make the best financial decision that they can possibly make. If a piece of property has both a primary residence and a rental property on it, could it qualify for an exchange? Yes, but only for the percentage that is a part of that investment. And they really need to be getting tax advice when they're doing that. We talked about what like-kind property is. We talked about the 3 property, the 200% and the 95% rules, the 45 and 180 days. These are calendar days. If they fall on a legal holiday or a Saturday or a Sunday, the day still applies. We don't automatically bounce it to the next day. It is a bright line calendar day. There are no extensions to the 45-day ID period. Make sure again that those identifications are in writing. The 180-day deadline can be extended if cut short by the earlier occurrence of the taxpayer's filing date, but that gets a little bit more complicated. The boot is the extra money that we have there, whether the cash or the mortgage that we're paying off. And it's just gonna keep moving on. I do that when I'm doing the class,
Right.
so that it's not like the same.
Changes up, right?
The
I was
same
thinking
side
same
of it
thing,
over
yeah.
and over and over again.
Yeah.
I specifically do it.
I kind of knew that that was the thing, because you keep people's attention that way. you know,
Exactly, like
it
you're trying
changes-
not to make it,
Exactly.
or I'll move it to the top and have the
Yeah.
words at the bottom, like I'll
right,
flip back
yeah.
and forth with it.
But it doesn't
So,
work when you have the.
It doesn't work when I have the people's pictures that are in there. Can the basis be taken out and only the gain reinvested? No, both the basis and the gain have to be reinvested to defer the taxes. So if I have a property, I've already said I'm selling a property where I have $250,000 that I'm getting in cash. Well, maybe I sold it for let's say I sold it for $300,000, but I had paid $200,000 for it. So really, I only had $100,000 in gain. I can't take the other 150 as like, getting back my investment at the very beginning and only doing the gain. I really do have to use the whole 250 of it. So because this is a safe harbor, there are certain rules that are just going to apply to it. And I'm going to go to the end of it because I do want to talk about in the last couple of minutes here, and I don't think you need my math examples. So I'm going to go to my last slide. There we go. Okay, so the question really for us all is what's happening with the 1031 exchange program right now, because some of the legislation that we have out there right now, one of the ways that the federal government is considering making up some of this money that we are doing in trillions of dollars in expenditure bills. One of the ways that they are thinking about making up some of that money is to eliminate the 1031 exchange program. So this is a piece of an article, and I've got the URL for it down at the bottom, but what are the proposed limits that have come out there? This is really only what was being discussed as of a couple of months ago. I don't think there's any one human being that knows everything that we already agreed to in the bill that passed the Senate. And obviously we don't have any idea as to what the House bills are going to look like right now because we don't even really have them in final form yet. But the 1031 exchange program is in the crosshairs of the federal government right now because they feel like that's just a way that they will be able to recoup some money.
Yeah.
Hopefully it will not be, well, my actual hope is that they just leave it alone, because it is, if we do this, if we eliminated it, this would lock people in properties that they don't want to be in anymore and not allow them to make good investment and financial decisions because they don't want to take the tax hit right now. And if they sold this property, they wouldn't have enough money to buy what it is that they really want, because again, they're going to have money that's taken away in taxes. According to the U.S. Treasury Green Book that we got May 28th of this year, the American Families Plan proposed a limit to $500,000 in gain per taxpayer and per tax year. Married couples would get up to $1 million in gain. Information, again, is still very limited because we don't have a final bill yet. So this is just what was being discussed. When would any change take effect? Obviously, it has to become law, and then we have to have a start date for this. You would hope that there would be a little bit of grandfathering for transactions that are in process. So we shall see. When will we really be looking at it? This will probably come out in part of what Congress is calling their reconciliation process with the budget. So this is definitely there for some continued fighting about. If you want to Google anything out there right now, you could get a link to your legislator to let them know that you don't want the 1031 exchange program curtailed or eliminated. because obviously this is something that is good for real estate. And I don't think doing something that damages investors and commercial property owners is actually in our best interest
No.
right now. Because those people, you know, residential real estate is on fire,
Mhm.
commercial real estate, and these poor investors who've not been able to evict anyone in a year,
Mhm.
these are the people that are really hurting. So I don't think slapping them while they're down
Right,
is the appropriate tack to take.
not at all.
And you know, even with just a limit of 500 or $1 million, I mean, again, we have to use whatever money we put into these properties as well when we're doing the replacement. It's very easy to have a property that's worth $500,000. It doesn't mean that you're in fact a millionaire, just because you have a property that is that size. So our suggestion and what we need to do is reach out. But the biggest takeaways from today is obviously when you have people dealing with investment property, it may be worth asking the question. Having them do good research on who they want to use as their 1031 company, making sure, because we know these people don't read anything that we send them ever. Making sure, I mean, God bless. I had a transaction a couple weeks ago where there was a seller who was selling a property and they never ever got their gas turned on. So they refused to turn it on for the buyer to check it. And they got really snotty about it. And so then I was holding $1,000 in escrow, but the listing agent kept taking the information that my buyer's agent wrote and just like striking through parts of it to where the amendment was no longer complete whole sentences of English anymore. And so I told her, I said, look, I'm just gonna write an escrow agreement and I'm gonna send it to the parties to e-sign. And she's like, Cheryl, she's like, I don't think the seller's gonna sign it. I said, I'll bet you the seller signs it and doesn't read it. And I won.
Oh my goodness.
So I told her, I think it was like 2 hours later, I got it back. And then of course, a day later, the listing agent's like, well, wait, what did my seller sign? I'm like,
Yeah.
the escrow agreement.
There you go.
As the adult that they are. But I would say, honestly, really making sure that they read these 1031 exchange and that they ask the questions that they need to ask, particularly with what can you do with my money while you have my money? Because that's
That's
my,
so important.
that's the only fear. And then making sure that they understand their deadlines for everything. So that is it, guys. It is 12 o'clock.
I'm so glad I took this class. I learned so much. I had no idea what it was to begin with. I had no idea. I said, I don't know.
Hey, Cheryl, I have
Yes.
a quick question. This is Yvette.
Sure.
I have a quick question about, like, if you have an investor that has property in 1031 exchange, and then at the end, they decide that they actually like want to retire in one of those properties, like keep the, you know, so I guess sell the property back to themselves as their self.
No, they don't
Is
even
that-
have to sell it to themselves. What you do, let's say that I sold my property, let's say that I sold an investment property here and I bought a beach house that I'm gonna rent out.
Mhm.
What I really have to do is rent it out. I can't use it. I can't go down there a lot. There's actually there's information in the slides about I have to
Right.
really use it as investment property down there.
Right.
But I don't have to sell it to myself. It's just that, you know, 5 years from now when I retire, or let's say 3 years from now, I decide to retire, I move down there and I move into it as my primary residence. Then I live in it for 2 more years and decide I like the mountains better than I like the beach. I
Mhm.
do it at that point and it's my primary residence.
Okay. So
And it
you
has-
don't, it has, so then it just kind of falls out of the 1031 exchange?
Well,
So
it's
you're not
only
changing it
it's only
anymore?
a 1031 exchange until the moment that I buy it, right? The 1031 is only from the moment that I sell to the moment that I purchase property. The only other time that it really comes into play is if I sold it within 5 years of me buying it with 1031 money, then I'm gonna have gain on that. But if I keep it for 5 years and I lived in it for 2 of those years, then I'm gonna escape gain.
Gotcha.
Yeah.
Okay, and then the other question is, I guess, because it's, you know, what we talked about was a lot of buying and selling, exchanging when, you know, once you already have it, but like, how do you, I guess, start with the first one?
What do do you mean by starting
Like,
the first one?
I guess purchasing a property within, like to be used as 1031 exchange as your first one, or do you?
When you buy it, you're just buying property. So you don't have in your head at that moment what you're gonna do when you sell it. So when you originally purchased the property, you're just buying a piece of investment property.
Okay,
It's only when you go to sell it, you have the potential for tax consequences that you have to start thinking about 1031.
okay. And then if you're doing it like, because from what I understand, you can do it within a self-directed IRA as well. Does that become your 1031 company, I guess?
Those people, that is actually, when you're doing it with a self-directed IRA, then it really is your IRA buying the money, buying the properties, and the property is the investment. So what your tax consequences are dependent upon like what type of account it is and whether you pay taxes on the front or pay taxes on the back end. Like whether it's a conventional IRA or a Roth, will depend. But in that case, when it's sold, that's not personal gain for you because that's an investment vehicle that's out there selling and buying it. And when you do that, you don't sign anything on the purchase side or on the sales side. The IRA company is really executing everything, and the deed goes into the IRA, the equity trust, blah, 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 for the benefit of Cheryl King is actually how it shows on title.
Okay.
So
I
don't think enough people really do that. And I've even talked to my own financial advisor about it. Like he doesn't like it because he thinks he shows his value when he picks stocks. But
right.
Because he charges us fees, right? When he picks
Right.
stocks. Yet if there's any industry or anything that I kind of know, it's real estate. And there would be the possibility, it's just another way to further diversify your portfolio if not everything is in the market.
Okay, so but in that case, it's not a 1031 if it's in your IRA?
No, it's not, because that is your investment vehicle is buying and selling it, and you haven't realized it until you take the money out of your IRA.
Gotcha. Okay. That was a little confusion for me. Thank you for that clarification.
You're very welcome. So you guys have a great day.
Thank you. You too.
Thank you.
Bye.
Thanks.